This is the Just Alpha Weekly Market Recap for Friday, December 5th, 2025. This week we saw a modest uptick in major U.S. equity indices. The S&P 500 rose by 0.34%, while the Nasdaq 100 led the pack with a gain of 1.01%. The Dow Jones Industrial Average added 0.60%, and the Russell 2000 increased by 0.81%. On the fixed income side, the 10-year Treasury yield climbed by 12.3 basis points, reflecting a slight uptick in investor sentiment around economic recovery. Meanwhile, the U.S. dollar index slipped by 0.46%, oil prices fell by 2.89%, and gold lost 0.38%, indicating a shift in risk appetite among investors. The week was characterized by mixed market participation. While major indices saw gains, the advanced decline ratios across different sectors revealed a more nuanced picture. The overall market had an advance to decline ratio of 0.90, indicating that slightly more stocks declined than advanced. However, when we zoom in on the megacap segment, we saw a more robust advanced decline ratio of 1.08, suggesting that large tech stocks were benefiting from positive sentiment. This was in stark contrast to the small-cap segment, which struggled, posting an advanced decline ratio of just 0.72. Market movements were influenced significantly by a combination of macroeconomic news and dealer positioning. The easing price pressures, highlighted by benign inflation reports, seemed to provide a tailwind for equities. With the Fed's focus on inflation, the expectation that monetary policy might ease sooner than previously anticipated encouraged buying, particularly in growth-oriented sectors like technology. As we navigated through the week, dealers were positioned long gamma, which meant they were incentivized to buy into market dips, stabilizing prices. However, there was a notable shift as we approached the end of the week. Some dealers began to unwind short gamma hedges, which contributed to volatility. In terms of options flows, the activity around key strikes indicated a mixed sentiment. Many retail traders were focusing on call options, betting on further upside, particularly in tech, while institutional players were seen hedging through put-heavy structures, creating a tug-of-war effect. This back-and-forth dynamic contributed to intraday volatility, with the market responding sharply to liquidity conditions, which were generally supportive but thinned out during the latter part of the week. Turning to the cross-asset themes, we observed that the bond market's reaction to rising equity prices was somewhat muted. The increase in the 10-year yield suggests that investors are beginning to factor in growth expectations, but the drop in the U.S. dollar indicates a potential retreat from safe haven assets. Oil's decline could be tied to broader economic concerns, particularly as energy demand forecasts were adjusted downward in light of softening economic indicators. Gold's slip also reflects this shift, as risk-on sentiment tends to decrease the allure of non-yielding assets like bullion. The breadth of the market gives us vital clues about leadership and sustainability. While the overall market showed a slight uptick in stocks above their 200-day moving average, participation in certain sectors, such as energy and utilities, weakened considerably. The advanced decline ratios in these sectors suggest that the rally may not be as robust as it appears at first glance. For instance, energy stocks saw a staggering decline in their advanced decline ratio, down 13.76, indicating significant selling pressure. As we look toward the coming week, a crucial question arises. Will the breadth of the market confirm this leadership, or will it fade as we approach year-end? The upcoming Fed meeting and economic data releases will be pivotal in shaping market sentiment. If breadth can hold above key moving averages and the advanced decline ratios improve, particularly in the lagging sectors, we could see a more sustainable rally. Conversely, if the major indices continue to rise while breadth deteriorates, it could signal underlying weakness that may not support higher prices in the long term. Investors should remain vigilant as we navigate through these complex dynamics, where each piece of news can have outsized effects on market behavior.